Hello class, welcome to this video. So for this session, we will be still discussing adjusting accounts for financial statements, specifically the accrued expenses. So for this video, we will prepare and explain adjusting entries, specifically the accrued expenses. So you might be wondering right now, what are the accrued expenses? What's the definition of this? And what are the transactions that give rise to this type of expense? Again, to give you a brief background of the other types of adjusting entries, you would have prepaid expenses, depreciation, unearned revenue, accrued expense, and accrued revenue. So accrued expenses, to define, this refers to costs incurred in a period that are both unpaid and unrecorded prior to adjustment. So in the first bullet point, what the keywords here would be the words incurred, okay? So the expenses that you used or have came up arising to another transactions, but they remain unpaid and unrecorded prior to the date of adjustment. Okay? So these two criteria must be met. That cost should be unpaid and unrecorded. All right? So generally, they relate to expenses incurred for services provided or products received for which the company has yet to be billed. So it says here, examples of your accrued expenses are services that were provided to you. Okay? In this case, you are the customer. Okay? The services that your supplier, sorry, the services that the seller provided to you, or the products that you received from the seller. Okay, so you must have obtained these services already, or you must have received these products already physically. Okay, but you were not requested or asked to pay it yet. Okay, neither the seller nor the service provider hasn't billed you yet of the final amount. Accrued expenses are part of expenses and reported in the income statement. Of course, expenses, this is a type of equity, right, that decreases the value of your company. And expenses are part of your income statement. Adjusting entries for recording accrued expenses involve increasing your expense, and when you increase your expense, you put it on the debit side. And also, you will recognize an accounts payable by crediting your liability account. So for the accrued expenses, two accounts here would be involved. First one, your expenses. Expenses will increase as a result of the service that was provided to you, or as a result of the product that you received from your supplier. And since you did not pay for it yet, because neither the service provider nor the seller billed you yet, you are required to set up or recognize an accounts payable, which is a liability. So the common examples of accrued expenses would be your interest, salaries, rent, and taxes. So we use interest and salaries to show how to adjust accounts for accrued expenses. We will have one sample on how to adjust interest payable and salaries payable in the succeeding slides. But as you can see here in the table, you have here the approach, okay, on how to recognize an accrued expense. As mentioned earlier in the previous slide, you recognize an expense as a result of the service that was provided to you, or as a result of the products that you have received. Okay, so when you receive those benefits, that will be subject for a recognition of an expense. And when you recognize an expense, or when you incur an expense, that will be shown on the debit side of the T account. So you would put here an amount under your debit side. And also, this is considered as accrued expense because neither your service provider nor the party who provided goods to you hasn't billed you yet. Okay, and since those suppliers didn't bill you yet, you you have the obligation to pay you when the time comes, and that payment will be subject to 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 the date wherein both parties have agreed. But on the but as an adjusting entry, what you need to do is to set up an obligation, okay, or a commitment to your supplier that you will pay them sometime in the future. That's why you credited here liability. So in this slide, we will be discussing how to recognize an accrued interest expense. Accrued meaning that that the passage of time has already happened, okay, or from the beginning of the period up until the end of the period, these costs have already been accumulating, okay. And in this slide, we will be discussing how to recognize interest expense and how does it come up for us to recognize an interest payable at the end of the period. So it is common for companies to have accrued interest expense on notes payable, certain accounts payable, and other debt at the end of an accounting period. So interest expense is incurred with the passage of time. Passage of time meaning that as the days goes by, okay, this interest piles up or accumulates. That's why you have to set up a liability account in the form of interest payable. And this interest payable or your obligation, okay, to pay the supplier, okay, or the service provider in the future, this arises because of the interest that was accumulated from the note payable that you issued. Okay? Unless interest is paid on the last day of an accounting period, we need to adjust accounts for interest expense incurred but not yet paid. Okay? So take note that we only perform adjusting, okay, for accounts, okay, for interest expense incurred but not yet paid. So the interest expense should happen already, but we haven't paid for it yet. Okay, no payment yet has been made. So how do we get how much is our interest expense? So to get the interest expense, we just use the simple mathematical equation of principal rate times time, or your PRT. So here are the variables. So your interest, you would have here the principal of the note, okay, or the face amount of the amount that you're obliged to pay. And then multiply it by your agreed interest rate, okay? So put it in an annual basis and then multiply it by years. And if it is less than a year, just just divide the face of the note payable all over 365 days. Okay? So your numerator would be the life or term of the note payable all over 365 days to get the exact duration of the note payable. So let's sample one. So it says here, we purchased equipment costing $6,000 by issuing a 7% 6-month payable on March 1. So again, prior journalizing, what we need to do is perform the first step in the accounting cycle, which is to analyze the transaction. And when analyzing a transaction, you should first ask yourself, is this transaction a financial transaction or non-financial transaction? In order to determine whether it is a financial transaction, you would need to analyze, like, if there are any factors here or accounts that affected your accounting books. So it says here, our company purchased equipment. So when we purchase equipment, it has an effect of increasing our asset balance because equipment is an asset, right? And then it cost $6,000. And then now ask yourself, how did we pay for the $6,000 equipment that we just purchased? Was it through cash, or did we provide, or did we give the seller a promise or a commitment that we will pay them in the near future or in some time? So in this case, we gave a promise, and that promise is evidenced by a formal document through a note payable. And that note payable is bearing 7% annual interest rate. Okay? And the life of the note payable or the term is good for 6 months. Okay? So this simply means that at the end of the life of the note payable after 6 months on March 1, okay, the obligation will now need to be fully paid by the company. Okay, but for the critical parts here in getting the interest, what's important here is get the principal of the note. In this case, it is $6,000. Okay, and get the annual interest rate. It was stated here, 7%. And get the time. The time you would be able to get here, since this is a 6-month payable, right? So we will assume that that the total interest, okay, would be half a year. Okay, but since we are only getting the interest expense as of March 31, we need to get only the interest expense good for 1 month. Okay, and from March 1 to March 31, there are a total of 31 days. So in the time here, instead of putting 6 over 12, okay, because this is a 6-month payable, this is not our answer. We should get exactly how many days is the note payable outstanding from March 1st up until March 31st. So in this case, it was 31 days. That's why we put it here in the numerator as 31, and we divide it all over 365 days. When you get the product of all of these three variables, okay, you would get that the interest expense for 1 month would be $35. So once you get this $35, you already know, or this signifies that this is the interest expense that you've actually incurred since you started issuing the note payable. This interest expense accumulated since March 1st up until March 31st. Okay? And this interest expense, you would need to pay it in the future. Okay? That's why we will set up a liability account for this one. And now we should perform a journal entry or adjusting entry to formally document the adjustment. So in this case, again, in every journal entry, there are 5 components to it. You would need to put the date of the transaction, the debit account and the credit account, as well as the amounts associated to these accounts, and a brief explanation on the transaction. Since expense, the normal balance of this is a debit, we put interest expense on the debit side to show that the expense account increased. Okay, and since this interest expense incurred starting March 1 to March 31st, then we have a commitment, or we have an obligation to pay our seller, okay, in the near future or sometime, but not on March 31st. That's why we set up a liability account by crediting interest payable. And the amount would be $35. To refresh your memory, we obtain $35 by this formula: principal rate times time. Principal was $6,000, rate was 7%, time was 31 days for the entire month of March, all over 365 days, which signifies 1 year. And when you get the product of this, you would be getting $35. So this is how you calculate for the interest. Again, just using the simple principal rate times time. And this is how you prepare an adjusting entry for your accrued interest expense. On this current slide, this is a new type of accrued expense in a way that this talks about salaries. Okay, it says here accrued salaries. So what are accrued salaries? So accrued salaries are the amount that we owe to our employees, right? Let's say, for example, the payroll policy is that we will pay our employees every 15th and 30th of the month. Okay, say for example on the first payroll on the 15th of the month, we will pay our employees the service that they provided to us from the first day of the month up until the 15th day of the month. So what happens here is that the our employees performed services in behalf of us, and we will need to pay them on the cutoff period, usually on the last working day of the bi-weekly. All right. So I'll just put in here, and let's just take it for an example for you to understand what is the nature of accrued salaries expense. So assume that we are ABCXYZ company, okay? And our employee earns $70 per day, or $350 for a 5-day work week, okay? Beginning on Monday and ending on Friday. So we are on the weekday operations. And our employees gets paid every 2 weeks on a Friday. So we pay out our we pay the salaries to our employees bi-weekly, and it is every Friday. Okay? Let's say for example, okay, for the month of March, we're talking about the payroll for March. Say for example that the second Friday fell on the 14th day of the month. Okay, so this is the first Friday. Sorry, this would be the second Friday, right? And the 28th would be the fourth Friday, which is consistent to our payroll policy that we will pay our employees every 2 weeks on a Friday. Okay? So on the 14th and the 28th of March, the wages are paid, recorded in the journal, and posted to the ledger. Okay? So it seems that on the first bullet point, there is no problem here, right? Because 28 falls on the Friday. Okay? So 28 is a Friday, and we were able to pay for that already. This is paid. And if we complete the calendar, we would have here 29 and 30. 29 would be a Saturday, and 30 would be a Sunday. So what happens now on the 31st? Again, we are operating every weekdays and the 31st fell on a Monday, right? And it's already at the end of the month. And it says here that the policy we will only provide salary payouts every Friday. So what happens to the to the work that was performed by our employees on the 31st on March 31st, which falls on a Monday? This is now considered as a salaries payable to them. Okay? So us, ABCXYZ, as an employer, we are obliged to pay the service or the work that they perform for us on for one day, which is for the March 31st. And how do we do it? Okay? So in the second bullet point, it says here that the calendar shows one working day after the March 28th payday. So March 28th, again, this is a Friday. This means that the employee earns one day's salary, okay, by the close of the business on Monday, which is on March 31. While the salary expense is incurred, it is not yet paid or recorded by the company because the policy is that we will pay them every 2 weeks on a Friday. Then the period end adjusting entry to account for the accrued salary is, so now this one day that was worked on by our employee, okay, and this is only it means that we have one day that one day in March that we haven't paid yet, right? So we need to perform an adjusting entry for this transaction. So in order to do that, what you need to do is to get how much, okay, is the one day salary by an employee. And then the first bullet, it says here that an employee earns $70 per day. Okay? So what we need to do simply is that for the month of March, right? Because we haven't paid yet the March 1 salary, what we need to do is to record that accrued expense in the form of salaries expense, debit it because you increased your expense by $70. And then since you will be paying this on the second Friday of April, okay, you would need to set up a liability because you are committed or you are obliged to pay, okay, your employee for the one day that for the one day service that your employee worked on, which is March 31st, $70. Right? And again, for every account, for every journal entry or adjusting entry that we prepare, we should update the detailed record for this account. In this case, salaries expense, put here on March 31st, write $70 because we already incurred this expense. Okay? And this incurred expense but not yet paid, this will be updated as part of your salaries payable. Okay? As you can see on the salaries expense T account, you have here salaries expense that you've already paid up, which is the second Friday. This is the second Friday. So no problem here because I already paid cash for this. And then the March 28th is the fourth Friday. Again, no problem here because I already paid cash for the salaries. However, there is again one day outstanding for the month of March that you haven't paid yet, this March 31st. So this March 31st will be paid, the salaries payable. This will actually be paid on the second Friday of April because that is what the policy says. The policy says here that the employee gets paid every 2 weeks on Friday. So this is still a liability part on you because you gave your promise to your employee, or you give your commitment that you will pay their 1 day March work or service, okay, on the second Friday of April. So in this topic, we covered how to compute for accrued interest expense. Again, this was simply getting in the product of principal, rate, and time. Also, we touched based on the accrued salaries expense and how to recognize um, salaries payable. If you have any questions, please feel free to pin it down in the comment or raise it during our class. Thank you.